With the high price of homes and high interest rates, some people are looking for ways to get creative financially to ease the pain of the high mortgage. And a lot of people just want to be in a home. They are looking for shortcuts and to get into home ownership. So I understand that some of these shortcuts are a necessity for some people. You got to be careful. Some of these shortcuts can cost you in the long run. So today in this video, I'm going to show you 10 dangerous home buying shortcuts that you'll regret. And you're going to want to stick around to the end. The last couple are really important, and a lot of people are trying to take advantage of those, so you're going to want to look at those. Look, what I'm here to do is just to explain to you what the risks are of taking some of these shortcuts. I am not saying to never take any of these shortcuts. I understand you're wanting to get into the house really bad. You want to own your own home. You want the mortgage payment to be lower. I get it. I totally understand. I'm not saying never do these things. I'm just saying be careful and look out. And what I want to explain to you today is just the risks of taking these shortcuts. So let's start off with zero down loans. We all know that zero down loans are really just USDA loans and VA loans. Yes, there are some conventional loans that you can do with zero down, but most of the time they're USDA or VA loans. The first problem with that is that when you get into your home, let's just say, God forbid, that the housing market takes a plummet. First thing you're doing is getting into the home with zero equity in your home. So if the housing market goes down, you lose your job, whatever, you need to sell your house. Now you've got to bring money to the closing table to pay off the difference. That is not a good thing. So another thing about the zero down loans is that you're going to have PMI, which is private mortgage insurance. You could possibly have PMI for the life of the loan. That's an extra payment that you may not have considered. Another big issue is that you are going to pay a lot more interest when you have a zero down loan because you're borrowing 100% of the money for the house. And so you're going to pay a lot more interest for that loan. Now look, I'm not saying that zero down mortgages are a bad thing. I do think that they are a good thing, but you just need to know what you're getting into. Like I said, know the risks and before you get into it so that you know what's going on. Number 2 shortcut that I want to talk about is having your parents co-sign on the mortgage. If you ever want to be invited to Thanksgiving dinner again, don't do this. It is not a good thing. What happens is if your parents co-sign on the loan and you default on the loan, then they are responsible for that loan. And if they can't pay the loan, maybe they don't, or maybe they haven't been notified in time. I've seen that happen before. Then guess what? Their credit report gets docked. And the other thing is their debt to income ratio is affected by co-signing on the loan. So if they ever need to go get another mortgage or borrow money for something, then they are affected by just co-signing on the loan. It's just really not a good idea. If you need, someone to co-sign on a loan for you to get a house, that is a big red flag that you are not ready to buy a home. You need to save more money or work on your credit or whatever it is that you need to do that first. Don't let your parents co-sign on a loan. It will create all kind of problems, bad relationships. It's just not worth the risk of doing that for your credit, your parents' credit, all the reasons I talked about. The biggest problem is you're going to have a strained relationship with your parents. That would be horrible. So number 3 is house hacking. Now, people have done this. What it is where you buy a home, maybe a duplex or something like that, or maybe a home that has extra space, and you invite someone into your home. They rent one side, you live in the other, and that will help you pay your mortgage. Now look, it can be done. A lot of people have done it. You go ahead, get the loan, buy the house, and rent it out. Now, if you are counting on your tenant to pay your mortgage, that is a very bad idea. What if they lose their job? Or what if they're just a flake and they don't pay you rent? And then now you can't pay your mortgage. That is a really bad idea. I don't recommend it. I have actually not had anybody do that. Thankfully, none of my clients have done that. So just don't do it. Renting your house out whatever. Let's just say, like in Des Moines area, we have basements, so a lot of people have a lot of extra room. I actually have plenty of extra room in my house. I'm not going to rent it out, but anyway, so rent it out. That should be for extra income, not to pay your mortgage. Just don't do it. That is a really bad idea and can be very dangerous. Don't do it. All right, number 4, we're going to talk about ARM loans. That is an adjustable rate mortgage. What an ARM loan is it's like a 5-to-1 or a 7-to-1 or a 10-to-1. What that means is that you're going to get a lower rate for the first 5 years, and then that loan will adjust to whatever the current mortgage rate is after that 5-year term. And typically that rate's going to be higher. So at that point, your mortgage is going to go up substantially, or you have to refinance. And refinancing at that point, you're not at 5 years. You're going to be paying mostly interest on that house, so you're not going to have a whole lot of equity in the home. It's going to be really hard to refinance to get into a conventional loan at that point. Now you have a little bit better chance if it's a 7-to-1 or a 10-to-1. It's really tough to justify just a lower rate by doing an adjustable rate mortgage, because you don't know what's going to happen in the future as far as rates go. If they go up and substantially and you got a much lower rate, then they could jump quite a bit. It's a huge risk. For most people, it's a huge risk. You're way better off just saving a little bit more money, putting a little bit more money down on the house, and getting your mortgage rate down that way. It's a much more reliable way to go and a much safer way to go. ARM loans can be dangerous. They can work out for some people, but a lot of times they end up being a huge risk. If you are looking for a new home in the Des Moines area, my name is Andre Dugas. I will help you find exactly what you're looking for. Whatever, maybe you're looking for a great community and a house with a great kitchen and a large shower or a bathtub, like one of my clients was doing. Anyway, so the next one, number 5, what we're going to talk about is stretching your budget to the max. Just because you got approved for, say, $500,000 doesn't really mean that you can really afford that $500,000 for a home. Most of the time, a lot of my buyers, and I really respect them for this, they don't take the bait and they go ahead and buy a home. A lot of times, quite a bit less, which helps them in their budget situation so much. What happens is, in the long run, you're going to get into a loan, and guess what? I know that your loan officer told you that, this is going to be the price of the mortgage for the life of the loan. Well, guess what? That is just, principal and interest. They're not talking about property taxes and insurance. Property taxes and insurance could possibly go up. More than likely they will. How many of you have heard of taxes going down? Actually, I've kind of heard of that recently. But anyway, let's not talk about that. What the chances of that mortgage payment going up, and if you're stretched to the total max of what you can afford per month, and that price goes up, you're going to be very stressed out. And it's just not a good idea to stretch to the maximum limit of your budget. Go ahead and look at homes that are a little bit less than what you're approved for, and you're going to be very comfortable in your house. Another thing that I tell people all the time is you're going to want to do things to the house once you get in it. Brand new house, whatever it is, maybe you want to put some landscaping in. I've seen landscaping cost up to $30,000. Maybe you don't want to do that kind of renovation, but I guarantee you it's close to a couple of thousand or at least $5,000 for landscaping. That's just one example. You're going to want to buy furniture. You're going to want to do some things to your house right after you get into it. It's a new house. You're going to want to make it new, make it feel new. You're going to want to do some stuff, spend some money, and you may not have it if you stretch your money to the maximum on buying the house. I don't recommend it. The number 6 shortcut is working with an online lender. Now, look, all online lenders are not bad, but we all get taken in. It's really easy to get online, put in your information, and get an approval letter. I get that. Also, a lot of people are looking at these rates, whatever company you're looking at, and these rates are teaser rates. Oftentimes, you get into this loan with the company that you got pre-approved for, an online company, and they teased you with a great rate, and after you get into it, you get into underwriting, and the rate is going to be higher because of something that they found. It's because they don't ask all those questions at the beginning. Local lenders have to do that. Sometimes you'll get into a loan, you have a situation where somebody uses an online lender or whatever, and they get to that higher point, that higher interest rate, and then they back out and go with the local lender, which I would highly recommend. I've got a lot of great lenders, and they usually work a lot better for everybody in the long run. So they get with the local lender, and now they're asking enough questions. Maybe you have some cash, or maybe it wouldn't be very hard to wait a month or whatever and save a little bit of money, pay off that whatever it is that is causing your bad credit. Now you got better credit. Now you can get a conventional loan. Now you don't have PMI. With a lot of these loans, if you get an FHA loan, they're going to have PMI and then private mortgage insurance, and that is an extra cost on your mortgage for the life of the loan a lot of times. So look, I'm not a lender, so I don't know all the details, but I have people for that. I have enough to do with working with the houses and making sure I get you the proper house. But the loan officers, the private lenders, what I recommend is use a private lender, call several of them. If you want to use an online lender, that's fine. Just, compare. Maybe call a couple of the lenders that I recommend. See if you connect with them a little better, so maybe they're a little bit nicer. Maybe they can give you some better ideas about what you should do with buying a home. Look, this is a big investment for you. You want to get it right. And some of these private lenders, a local lender that you can talk to, a real person every single time, call them, often, and they answer the phone. They're nice. They ask the right questions, and they put you into a great mortgage situation that is helpful to you in the long run. I've seen it time and time again. Actually, I haven't seen a whole lot of people use the online lenders because the local lenders are so much better. And I have seen a couple of people use those online lenders, and it worked out fine. One of my buyers just recently told me that when they bought their house, the last house, they used that mortgage company and they loved it. So anyway, I would use a local lender, and I got a list of them that I can recommend to you. All right, so the number 7 shortcut that can be dangerous is using down payment assistance and not paying attention to the term. I'm not against down payment assistance or first-time home buyers assistance. I get it. A lot of people need that help or want that help, but you got to be careful. Some of these are actually loans. Some of them have a stipulation where you have to live in the house for 5 years before that money is not going to be repaid. Otherwise, it's a loan. So whatever, let's say you get in the house, something really bad happens, you have to sell the house, and it's only 3 years down the road. Now you have to pay back that loan. That wasn't free money. So read the fine print. It's extremely important. It could be a grant. Maybe it was free money. Maybe it's a great proposition. But just be careful. It can be very dangerous for you. Down payment assistance. If you need that, then maybe you ought to look at possibly, waiting a year or two and saving up your own money. That's what I would recommend. Just don't jump right into something like that. If you need it, and if you are going to do it, just read all of the fine print. It's very important. It can be very dangerous. You could owe a lot of money. Typically, it's about 3% that they will give you, which a lot of times will cover the full down payment, and that could be a lot, depending on the house you buy. So number 8 is not using a buyer's agent so that you can get a better deal by not paying the commission or just working directly with the listing agent. This is a big one. A lot of people think that if they just, go and deal with the listing agent themselves, that they can save a lot of money. And maybe it's very unlikely, actually, because that listing agent is not working for you. She is representing the seller, or she or he is representing the seller. So they're not going to help you negotiate the terms of the contract, price of the house, or when you're having to negotiate for repairs after the inspection is done. They are not going to be doing you any favors. It is not a good idea to be represented by somebody in a situation where they're representing the opposing, the seller. In this case, it would be like going to court and being your own attorney and asking the other attorney to help you out. That's similar to what you're doing. It is just not smart. Now, and sometimes the listing agent will ask you to sign a buyer's agency agreement, which we all have to sign if we're working with somebody or if we're showing them a house. If you sign an agreement with her or him, then you're going to actually have to pay that commission. And if she's working for the seller too, she's not going to offer to pay that commission, for the seller to pay that commission. Oftentimes, though, if you're working with a buyer's agent, more than likely, yes, you're going to have to pay their commission. It's 3% in most cases. But it's negotiable. And, when you sign that contract with them, a lot of times, still, even today, after the big lawsuit, we can talk about that. You may call, I'll tell you all about it. But even after the lawsuit, a lot of times still the listing agent and the seller are paying the commission because they want to attract buyers. And if you're going to a house and you're going to have to pay the commission, it can add a lot to the cost of the house, and they don't want that. So they're still a lot of times paying the commission. Maybe not every single time do they pay the whole 3%, but you can negotiate that. I will negotiate that for you. That is my job. That's what I do. So don't try to do this by yourself, especially if you're going to go against another listing agent and you're asking them. Whether you're asking them for help or not, they're representing the other side and you haven't done this. And so there might be some pitfalls that you run into, and it could be a problem. And number 9 is buying a house without an emergency fund saved up. Look, I recommend that you have after you close, after your down payment, after you close your house, you have 3 to 6 months worth of savings. I know it's tough, but you're going to get into the house and, there's a possibility that something might happen and, then you're, a big expense. We talked about it earlier, possibly, roof, air conditioner, hot water heater, anything could do it. If you have maxed out, you drained your bank account, and you don't have any money saved up, what happens if your hot water heater goes out? What happens if your sewer backs up because the previous owners, put towels down the drain? I don't understand why they did that, but what happens? Now you are, pardon my language, but you're screwed. If you don't have the money to save up for an emergency fund, you have no business getting into a house right now. You just need to save the money before you jump in. This is a really big decision, and it can be a big financial drain. It can be a huge stress if you're right up against, you don't have any savings. If you, borrow the max, or if you don't have any savings, you could run into some problems. I don't recommend you doing that. So, number 10, this is a big one. Borrowing money from your 401k for down payment on your house or just for the house buying process. Now look, a lot of people have been doing this recently and, it could possibly work out. But what happens if you borrow that money? You can borrow up to half of the cost of the house or $50,000 and whatever's higher. And, you can use that for the buying process. What happens if you do that and then you lose your job? Then what happens? Well, you will be responsible for the remaining balance, and it can be considered as taxable, and then you're going to have a 10% penalty if you are under the age of 59 and a half. So that's a huge penalty for borrowing that money, and you don't know if you're going to lose your job or not. So just be really careful with that one. Another thing that you might not know about using the 401k is that you may not be able to make contributions to the 401k anymore until you pay off that loan. You borrowed $50,000, now you got to pay it back. A typical time for that is 5 years. So you have got to pay that back during that 5 years. Another thing is, now you've taken out $50,000, you have to pay it back. and you losing the income that you would be making for the growth of that money in as an investment. It's just a tough situation. Definitely, if your loan officer is recommending that you do that, you really need to understand what's going on. I feel like sometimes they don't really explain all the details of what possibly could happen. You just got to know, these are risks that you are going to take. Some of them are huge risks. This to me is a big risk. Whatever. Let's just say it's $25,000 or 50, whatever. Let's say it's 25. That is a big amount if you just lost your job. That could be a real problem. So here's the bottom line. Don't rush into home ownership. Take your time, save your money for your down payment, your closing costs, and your emergency fund. Just don't rush into this. It is a big investment. Be sure that you're prepared and don't take any of these really big risks. If you're looking for a home, get in touch with me. My contact information is below, and I'll be happy to help you. Thanks for watching. See you on the next video.